Hey, welcome back everybody. It's Travis here with JT Wealth. My first video of October, and I wanted it to be a good one. So what I have for you guys today is one billionaire who considers himself to be a student of Warren Buffett has managed to smoke Warren Buffett's returns over the last year or so with 30% annual returns with these three income stocks. We're going to talk about those stocks and where they could go in the future and whether or not they're good for your portfolio. So let's get into it. Alright, like I said, welcome back everybody. Thanks so much for checking out the channel. Hopefully you find something of value in the three stocks we talk about today. If you do, don't forget to smash that like button for me and consider subscribing to the channel as well. Also, if you want to stay up to date with all my new videos, hit the link to the bell down there and that will just kind of update you guys every time I put out new content. Alright, so anytime you have somebody saying they're beating Warren Buffett's returns, you have to stop and pay attention. And the person we're talking about today is Billionaire Bill Ackman. And this article came off MoneyWise, and it says Billionaire Bill Ackman is smoking his mentor Warren Buffett with these income stocks. Alright, and just a quick differentiation. When we say income stock, it is not meaning a growth stock. An income stock is something that just pays out to its investors consistently and often steadily increasing those payments. What we're talking about with income stocks is dividend paying stocks. And I know you're probably thinking dividends are kind of boring, it's not super interesting, but the numbers don't lie on this. And the billionaires out there, they're gonna agree with me. You need to be invested in dividend paying stocks to grow your portfolio in the most efficient way possible. You simply won't keep up otherwise. So the billionaire Bill Ackman, he owns Pershing Square Holdings, and that specific fund has beaten the S&P 500 and Warren Buffett over the last 3 years, coming up with an annual return of 30% each of those 3 years. And he managed to do that by being invested in dividend-paying stocks. His latest 13F report to the SEC shows that by market cap, 60% of all of their funds are actually held in dividend-paying stocks. 60%. All right, now let's quickly look at three of the stocks that he holds in that portfolio to get those kind of gains and whether or not you can take advantage of them too. So number one on our list today is Restaurant Brands International, ticker symbol QSR. And we're leading off with this one. They have the fast food holding company, and this was formed in 2014 by a merger between Burger King and the Canadian coffee chain Tim Hortons, which, by the way, is so delicious. I miss Tim Hortons. If you're my friends in Canada, send me some Tim Hortons. Now, in 2017, the company also added Popeye's Louisiana Kitchen to their portfolio, and like everybody else in 2020, they did dip significantly, but they've had such a strong recovery that the rebound has more than made up for that loss. Now, a key measure of their retailers' health was their same-store sales that increased 27.6% over the last year, and their adjusted earnings came in at 77 cents per share for the most recent quarter, more than double the 33 cents per share it earned a year ago in the same period. It was also more than enough to continue their quarterly dividend payment of 53 cents per share with ease. And Restaurant Brands offers a healthy annual dividend yield of 3.4%, and anybody can take advantage of this with, just buy a share, buy a fractional share, whatever it is you need to spend on it. This is something that everybody can be involved with. Now, by comparison, they have a higher yield than other fast food chain restaurants like McDonald's, Starbucks, or Yum Brands. Now, looking at QSR going forward, the TipRanks website shows they are a moderate buy with 14 ratings, and check out that upside potential, guys. Over 17.5% in the next 12 months, taking QSR from $62.28 to possibly $73.23. So not only are you getting a fantastic dividend yield every single quarter, but you're also having the potential to make 17.5% upside. All right, the number two stock we're gonna look at today, this one I'm sure everybody's familiar with, it's Lowe's. And Lowe's, ticker symbol LOW, is Bill Ackman's largest holding by market value, and the position has served the billionaire investor quite well. The shares are up 29% year to date, whereas the S&P 500 has only returned 16% over that same period. And even more impressive than their near-term stock price performance is how the company's dividend has grown over the years. The economy moves in cycles, but Lowe's payout has only gone up. In fact, the company has increased its payout to shareholders every year for the past 59 years. That's decades of dividend hikes that have brought Lowe's quarterly dividend to 80 cents per share, translating to an annual yield of 1.5%. Now, its competitors are also dividend-paying companies like Home Depot with 2%, Target with 1.5%, and Walmart with 1.6%. And due to Lowe's rally over the past year, its shares now trade at over $200, but you can get a piece of that company using popular stock trading apps by buying fractional shares and stuff like that. So you don't actually need to spend $200 a share if that's not something you're feeling comfortable with. So it is a solid dividend payer over 50 years of growth, but perhaps 1.5% isn't as much as you would like. Like the company prior at 3.5% is significantly more. But what about the upside potential for Lowe's going forward? Well, Lowe's ticker symbol LOW, again trading at 203.70 on Friday at close, but check out their moderate buy rating, 11 ratings, and you're looking at 13.68% upside in the next 12 months to a possible price target of $231.56. So again, when looking at income creating stocks, you are going to get some growth potential, and with these three, it is fairly strong growth potential. All of the three are in excess of the 10% S&P 500 you can expect as a result of the last 100 years of data, okay? But you're also getting those quarterly payouts consistently, and if you use the DRIP or dividend reinvestment plan, you can just constantly push that dividend back into the stock and allow it to compound and grow your money for you. Now, the last stock we're talking about today is something you probably haven't heard of, and that's Agilent Technologies, ticker symbol A. Just the letter A. And they're not a household name, but within their own industry, the company is an absolute force to be reckoned with. Agilent provides bioanalytical and electronic measurement solutions to a wide variety of industries, including communications, life sciences, and chemical analysis. They're out of Santa Clara, California, and the company's products are used by 265,000 labs around the world. Now, in Agilent's fiscal 2020, it brought in $5.34 billion of total revenue. And in the most recent quarter, that grew 26% year over year to $1.59 billion in a quarter. Now, given that kind of performance, you'd think Agilent shares would be soaring, but while the stock has returned a solid 60% over the last year, yes, 60% over the last year, it has pulled back about 10% since its peak in September. Now, with regards to its dividend, they pay an annual yield of 0.5%, which doesn't seem like much, but the company has an excellent track record when it comes to returning their cash to investors. Since 2014, their share per quarter payout has increased by 106%. Now, we've got a strong buy for the Agilent stock with $155.99 priced on Friday at close, right? But they're looking at the potential for this to shoot up almost 17% to a possible price target of $182.38. So this is still a stock that people are confident about its continued growth. We've seen 60% in the last year, so it's possible that 17 is just an average. It could even go up more than that. Time will tell. All right, but those are three of the stocks that Billionaire Bill Ackman is using to beat even Warren Buffett's numbers, definitely beating the S&P 500, and he's doing it because they all pay out dividends that are being reinvested into the stock and compounding the growth of his successful portfolios. And everybody can utilize this same strategy, even if you don't like these three dividend stocks. You can get into any dividend stock you'd like, just make sure though they are ones that pay out consistently. You want to look for the dividend kings and the dividend aristocrats, companies that are going to continue their payouts confidently, right? Because you don't want to put your money anywhere where you're not significantly confident in their ability to make those payments. All right, but thanks so much for checking out today's video. Hopefully you found some value in it, and if you did, hit that thumbs up button and consider subscribing to the channel if you haven't already. Remember, this information is not stock advice. I'm not a financial advisor. It is only provided for information and entertainment purposes only to kickstart your due diligence so that you've got some idea of what you want to look for before market opens tomorrow. Do your own due diligence before investing any of your hard-earned money. And until next time, guys, bottoms up.